joined today by Alexander Scanlon, Managing Director of Barton Gold. Alexander, thanks for your time.
Thank you for having me, David.
A significant project portfolio in South Australia, millions of ounces of gold and millions of ounces of silver. You're using a hub and spoke model, essentially. How does that unlock the value for Barton Gold?
I guess there's sort of two ways to think about it. We're leveraging existing infrastructure, and then we're maximally leveraging that infrastructure. So the idea is to be able to quickly and cheaply transition into operations in the first instance means you can take a significant step off the back of that existing infrastructure. That means that the risk of going into operations is much, much lower. Obviously, much lower capital requirements to start operations than building a new mill. And then if you're using that sort of hub and spoke model, once you have cheaply gone into operations, you're able to leverage that infrastructure and essentially look for a lower risk way to bring in marginal grade in infrastructure that's already running, which means you'll produce more ounces from the same tons and drive down your operating cost, and of course then drive up your production margins.
You released a optimized scoping study which showed this Tunkillia project would generate in excess of $1 billion of profit in its first year. How do investors get their head around numbers like billions of dollars? And how do you unlock and actually retrieve that value?
So Tunkillia is kind of an interesting creature if we think about it from kind of the project standpoint. We did always believe that it was hiding something special in the middle, and we also believed it had potential scale. So we first focused on the scale side of that equation. We wanted to put together a project that could really anchor a large-scale production profile. So Tunkillia is the asset that does take us to scale. It has the benefit of a 300-meter long zone in the middle, though, where you have really broad mineralization, and a sliver that's 10 to 30 meters wide of 10 gram or 2 gram mineralization, so in that range. That is why we get these numbers. The way to think about that is effectively across the life of the operation, we might be producing 120,000 ounces per annum. But because you have this denser high-grade zone, essentially you're accelerating forward a number of ounces. So for 1 million ounces for life of mine of gold, 2 million ounces of silver, you're actually getting about 35% of the ounces of gold and 50% of the ounces of silver in the first 2 years. So in really simple terms, today you build the project for 400 million Australian dollars. In the first 2 years, you get about $2 billion back. So it's really just about cash in, cash out, and the timing of that. The key takeaway to that really is that kind of payback profile allows us to pay back the mine development, start returning capital to shareholders, and invest in growth in a way that most assets don't get to do.
You're targeting a PFS or reserve and the lodgement of your mining lease application by the end of 2026. Are you on track to deliver these important milestones?
We are. So we actually started the upgrade drilling for Tunkillia last year. Shortly after we published our optimized scoping study, we then went into early long lead environmental work. So with those types of economics, we hit the gas, we brought all of that stuff forward. In November and December, we were drilling the first phase of upgrade drilling, and that's actually targeting that higher grade zone there. So that mineralization underwrites the whole development. During November, December, January, we published a series of high grade results that infilled that. So we're already into the second phase of upgrade drilling, which is now we're looking at the metallurgical and geotechnical drilling. That will then, along with more RC drilling, upgrade everything to measured and indicated. And that will feed into pit optimizations and a pre-feasibility study. And then based upon that, we then fill in the blanks on the mining lease application.
Elsewhere in the portfolio, Challenger, you are working through a DFS, looking at a much simplified restart there. Can you talk through what's involved in that operation?
So Challenger is where we have 2 open pit mines. We have a couple other bodies of near surface mineralization that likely could and will be open pits. And then we have a high-grade historical underground mine. So this asset produced about 1.2 million ounces of gold between 2002 and 2018. Right in the middle of this, of course, we have an existing mill, and we call that Central Gawler Mill. So this is an asset that was designed to be a 600,000 ton per annum mill. And what we're actually doing between what we might call a scoping study we did last year on the refurbishment, which indicated you could restart the mill as is for $30 million. We're looking at a range of scenarios. And in a matter of speaking, we're kind of doing a scoping study, a PFS and a DFS all in one. So we're going to DFS level confidence on the costing of a number of different scenarios because we have the existing infrastructure. And the way that we think about it is, what's the cheapest way we could start this, or what's the most efficient way we could start it as is, but where do we really want to end up? We're looking at options that allow us to essentially very efficiently move from scale A to scale B to scale C to scale D over time as we build up optionality in that asset. So we're looking at start small, start lean, start efficient, and then give ourselves the runway to grow, particularly as we then bring up high-grade mineralization from the underground mine.
And at Tolma, you have just produced a silver concentrate of over 100,000 grams per tonne. How does that feed into the economics of that project?
Tolma is a very interesting opportunity for obvious reasons. We were looking for a gold discovery. We made a gold discovery, and then we found out it was actually a silver discovery with high-grade gold credits. So the discovery hole there was 6 meters at 4,750 grams silver, plus 13 grams of gold. That initial test essentially was mineralization that we dried and cleaned and panned to produce a concentrate to test the petrology, or sort of the genesis of that mineralization and the structure of that mineralization. The interesting thing about that result is it tells us you can actually produce an extremely high-grade concentrate by simple gravity processes. We didn't have to use chemical reagents. We didn't have to use hydrometallurgical or pyrometallurgical processes. That's obviously not representative of the whole thing there. We've got a shallow 100-gram silver horizon, and we've got a deeper horizon, which is still shallow, that has silver up to 17,000 grams. So we're really at the stages of trying to figure out, what is this? It's exciting, but what is it really? We're going to be drilling it in 2 weeks' time. We brought forward drilling to try to test a different orientation and infill that data. And in parallel, we're going to be running a scanning electron microscope to try to figure out what's the nature of this mineralization, and then full metallurgical test work. The short summary of all that is, we hope that that concentration indicates that there is a pathway to very low cost concentration of high grade material to produce a very attractive saleable product from a very small hole in the ground.
Boasting key infrastructure that will help unlock a number of opportunities within the portfolio in South Australia. A lot of projects moving towards DFS and investment decisions with some outstanding economic numbers wrapped around it. Exciting times ahead for Barton and its shareholders. Alexander, thanks for your time.
Thank you very much.